Good afternoon. Welcome to LBMA webinars. Today we hand over to LPPM in what would have been New York Platinum Week to discuss PGMs. Tom Kendall, Head of Precious Metals, ICBC Standard, will host Jim Steele, Chief Precious Metals Analyst, HSBC, and Peter Westerheide, Chief Economist, BASF. And Tom will set the scene for this webinar. If you have any questions throughout the webinar, please put these in the questions function, and if there is time, we will ask these at the end of the webinar. So with that, I shall hand over to Tom.
Thanks very much, Taylor, and good afternoon, or possibly even good morning to everybody who's joined us. Thank you so much. It's a pleasure to be in contact with people virtually when we can't meet as we would normally do in New York at this time of year. I'm not going to spend long on the introductions because half an hour is a very short space of time to try and cover some of the issues of what is always a really fascinating subject. I've been involved in the PGM markets myself for a very long time, more time than I care to remember, over 25 years. And between myself, Jim, and Peter, I think that there's probably getting on for a century of experience in these metals. So we should hopefully be able to give some people some good thoughts on what is going on both the financial side of these markets and the industrial side as well. We've got both covered with our two guests today. I think we can certainly all agree that these markets are never boring. They have very strong and idiosyncratic fundamental drivers with a financial and investment market overlay. So there's always something going on. There certainly is a lot going on in platinum, palladium, and rhodium at the moment. And so with that, I think I'll hand over first off to Jim to give us his thoughts. Then we'll have the same from Peter, and then, as Taylor said, we'll open the webinar up to your questions. Jim, thanks. Over to you.
Well, thank you very much, Tom, and thank you everybody for tuning in today. Half an hour is a short period, so I'm going to sort of specialize or try to look at the investment side of things, a few comments on supply, and I think leaving Peter to do a lot of the auto demand and maybe a couple of comments on jewelry and other industrial issues. But I think, you know, what is changing the most rapidly? You know, what is going to be the marginal impact on prices, because industrial demand and mine output tends to be slower moving, almost by definition. And I think if you look at these two slides here are put together for economy's sake, and we have net long positions on the COMEX, along with ETF demand, ETFs in the red. Platinum being the first one. And you can see, well, first of all, we can see that the ETF demand for platinum has been going up considerably. It was up 1.1 million ounces in 2019, and it continues to go up after a drop in March, which was along with the stock market decline and liquidation across the board in many commodities. We are back up again. And I think what is notable about this is that I'm not arguing for really compelling platinum fundamentals. I think they're okay, but I wouldn't necessarily argue that they would be by themselves necessitate a strong bull market. But we have a tremendous pull from gold, and I mean, in discussions with people all over the industry, and some of them haven't participated as much in the bull market and gold as they would have liked, or they haven't participated at all, and they look around for alternative safe havens, and platinum and silver provide that. And I think this has provided a lot of tailwind into the platinum investment, which has also spilled over into coin and bar demand, as our excellent friends at the WPIC have recently highlighted strong Q2 bar and gold demand. Now the COMEX positions have been and always are quite a bit more volatile, and there's been a lot has come out of the net long positions, as you can see. But if you combine the two, ETFs and the net longs, we've got about 4.9 million ounces in visible investment, non-coin, non-bar. Now, juxtapose that against the palladium. And you see here that we, after hitting a 3 million ounce odd high a few years ago, I mean, we're down to 500,000 ounces. And we did drop down well below 500,000, 450,000 odd at one point on the ETFs. And it's only 508,000 at the moment, and net long positions only around 368,000. So if you combine the two, I mean, we have well under 1 million in net positions there compared to the platinum. And the important point here is that, I mean, we are still looking for deficits, to reduce deficits, supply, demand, production, consumption. There's no such thing as a supply-demand deficit because the metal does materialize. But there is a reduction in production consumption deficits for the palladium, but we expect them to go back out. These ETFs are insufficient now to finance that. Before it was Russian stockpiles that financed it. Now, more recently, it's been the ETFs. So going forward, we're going to have to cannibalize or mobilize or draw on non-reported stocks. And no one knows exactly what they are. We only know that they've been down about 6 million ounces in the past number of years. Could I see the next slide? So it's a very different situation. I mean, for the platinum, you know, there's enough to draw on. For the palladium, not so much. And now for the PGM basket, I think this is very interesting. Switching over a bit to the supply section, the PGM basket. This is the 4Es. This is a typical South African basket, and in rand terms. And you see here that we've had, because of the rhodium and the palladium, principally, we've had a rocket in per ounce in rand terms. And I mean, I'm not an equity analyst, and we have a very good one at HSBC. So I don't know, I wouldn't profess to say exactly what each mine's profitability is, but at these levels up here, despite the dip, we're back up again. This means that the industry is basically in profit and enough to stimulate further demand. And we are looking for more supply to recover after the lockdown this year for next year, and both platinum and palladium from South Africa. But I think this is interesting because you really see it in rand terms. It's easy just to think about these metals in dollar terms, but South Africa is the biggest producer of platinum, second biggest producer of palladium, and in rand terms, it's what the producers are looking at. And the next one, please, if you don't mind. And here we see the South African recovery. We see the decline with the lockdowns. This is production data from South Africa in percentage terms from Statistics South Africa. And you see here that we had a pretty sharp decline earlier in the year because of the lockdowns, which were government mandated. The industry is coming back, but it's not easy. I think they've done a very good job, particularly in the mechanized mines. We're looking for production to increase in both platinum and palladium from South Africa substantially next year, which will help moderate the deficits we see, at least in the palladium. But there is still a long way to go, and we have to hope and pray, of course, that we don't have any resurgence in lockdowns or mine shortages because of COVID-19. There's nothing so far. So please don't take me the wrong way, but we have to be careful. And I was trying to think of what was different, what I could say that I thought would be a bit different for the purposes of our discussion. And I thought I would talk about something a little bit more outside the box. The EU Commission presented statistics talking about supply difficulties for a whole range of metals, supply vulnerabilities. Now, PGMs didn't rank very high on that, but they were there. So I think that is important to remember. And the British Geological Survey, and this is a very old one, it goes back to 2015, so it's not modern, and I don't mean to present it that way, but they consistently pushed PGMs up the list on their supply index risk. They have which was compiled by Andrew Bloodworth, and out of the 42 metals that they looked at, the PGMs ranked 14th, 7.6 out of 10, 9.5 being the highest. They were the rare earths. And outside of China, metals coming out of China, PGMs were just about at the top. So I mentioned that we still do have, from all sorts of reasons, supply vulnerability because of the limited geographic area that both the PGMs come from. I don't mean to be alarmist. We're not forecasting sharply higher prices, but it's always something to bear in mind. Gold, by the way, was at the bottom. Was number 42 because of the ample above ground stocks. And so I think that is interesting. Just a quick word on the jewelry. It's still lagging a bit, but we do have some recovery for the platinum jewelry, that is. We are looking for some recovery going forward, but I wouldn't be overly enthusiastic about it. It looks to me like the new surge is coming in from bars and coins, but it's related to the gold price, whereas the palladium can stand on its own supply-demand fundamentals. I think I should stop it there, Tom.
Perfect. Thanks so much, Jim. We'll circle back and pick up on some of those points that you've raised towards the end. But I think for continuity's sake, we'll let Peter give us his thoughts now, and then we'll take the questions that come in across the webinar. Thanks very much, Jim, and over to you, Peter.
Yeah, thank you, Tom, and good morning or good afternoon, depending on where you are. Thanks for inviting me to give some, let's say, fundamental thoughts on the demand for PGM. And basically, every economic presentation currently starts with these kinds of slides, which show in the end the development of the COVID pandemic, because, of course, it's to some extent still governing the global economic development. And I don't want to go into details here, but what you see simply here on the left side is the development of new infections in the world, cumulative, and that means in the end, that we are not over the peak yet. So we are still in the middle of it. But what we can say is and see currently is that we see to some extent a kind of decoupling of the economy from these infection rates. It's more currently younger people who get infected. It's less fatalities, and even in those countries where we have high numbers of fatalities, at least it does not lead to this disastrous and strong economic consequences we have seen in the second quarter. So governments react differently and people get used to some extent to that. Next slide, please. Yeah, if we are looking at global economic forecasts currently, we can at least say that they have found now their bottom. For a couple of months or weeks in the first half of the year, we have seen a strong downward revision tendency in overall economic forecasts, so describing overall income generation in the world. And now, indeed, we have found a bottom, and for some regions and countries, we even see slight tendencies to revise forecasts upwards again. That is, for example, true for the United States, where recent forecasts are more towards 4% minus for this year. That is the case for China, where others are probably even more optimistic than this forecaster here, which is IHS. For European Union, a lot of, let's say, heterogeneity. Some countries doing better, like Germany, for example. Some are really worse off compared to the better ones, for example, Italy, France, and probably also Spain. So the southern periphery is hit quite strongly. So we have a lot of differences here, but the, let's say, bottom line is that we will see probably global growth declining by 5% this year approximately. And for the years to come, we see a recovery. However, not a full one next year already. Recovery is strongly driven by China. If you look only into the so-called advanced economies, taking out the emerging world, you will even see a slower recovery here. To come back to the 2019 levels will take at least 2022 or 2023. Yeah, so really slow recovery here in this regard. Now let's come to the industries more, to the picture and demand for PGM. Next slide, please. Okay, here just to give an overview here. For me, interesting, probably you all know that, but for me, it was interesting just to dig out these numbers once again. What is the demand pattern for PGM? For platinum, it's 1/3, but overall, if you look into palladium, rhodium, and the sum of the major PGM is 2/3 of demand coming from the automotive industry. For the sum of all major PGMs, if you look into palladium and rhodium, it's between 80 and 90%. So really the automotive industry is the big driver here for the PGMs. If you price weight it, it's even nearly 80% of the total market that is drawn by the automotive industry. And therefore, let me look a bit more in depth into this driver. Next one. So that is what we have seen in the automotive markets in the latest months. So it ends here at the hard data edge in July 2020. And what you see here in the data is that indeed we have seen a, to some extent, surprising recovery since the second quarter, which was of course disastrous for the whole automotive industry. But since then, the recovery was, I would say, a bit better than expected. Particularly that was the case in China. Was a strong recovery here, not only in light vehicles, that is shown in this slide here, but also, for example, in trucks. Yeah, so really surprising growth here, despite probably not giving so strong subsidies as it was the case in 2008, 2009. It's much more, let's say, focused on certain types of vehicles, new energy vehicles, hybrids, and battery electrical vehicles than it was the case in the crisis before. Despite this, let's say, reluctance of governments to give broad subsidies to the markets, we see a quite vivid recovery now in the third quarter. For the full year, we will probably, next slide, please. For the full year, we will probably reach a level of production of 70 million units this year. Order of magnitude here with ups and downs depending on the forecast. So these are external forecasts again here by LMCA. And for the next years to come, we see a recovery in the market with the levels of 2019, which was already a quite bad year, reached in 2023. To reach the levels of 2018, it would probably take until the mid of the decade. So kind of slow recovery here, but at least we will see a recovery here in the market that is basically shared by all forecasters currently. Of course, we have some segments of the markets that are developing somewhat better than others. And this is particularly true for car segments that are now subsidized and supported by regulation, which is battery electrical vehicles. However, the share is still small. For 2023, here in this forecast, it's 7% of the total light vehicle markets, battery electrical vehicles. If you include trucks and so on, of course, the share would be even lower. So it's growing, but it's not so strongly growing. BEVs, of course, the share is not really supportive for PGM demand because they have no catalyst. For all the others, basically, we have a combustion engine in the car and therefore also a need to build in catalysts and to have PGM. So overall, next slide. Outlook for the market is positive for the foreseeable future, particularly also driven, and I don't want to go into the details of this very complicated slide here, it's driven by regulation. We have a tightening of emission regulations going on, and that of course also triggers further demand for catalysts and also demand for PGMs. No time now to go here into the technical details, and I'm also not an expert on that. My general takeaway here is that demand will be quite robust. However, Europe, there are some question marks in the longer run. As you have certainly noted, we have again a tightening of emission regulations in the European Union now of 50% of CO2 emissions compared to 2021 instead of 37.5% is currently discussed for the end of the decade. And of course, you need to have really advanced technologies in combustion engines to come to such low consumption levels for fuel. On the other hand, it's a driver also for battery electrical vehicles. So it's kind of, let's say, probably tipping point. You need really advanced technologies to reach that with combustion engines. You also need to have a kind of higher share of BEVs in order to reach it. So it's really quite of a question here, what really will be the outcome for the catalyst demand and also for PGM markets, given such emission targets. Probably we can discuss that later on. I think that will be a tendency that will be influencing the markets in the foreseeable future towards the end of the decade quite significantly. Yeah, with that, I would like to end and back to Tom and to the questions.
Perfect. Thanks very much, Peter. That's really given, I think, everyone some great context to put the demand in the automotive sector in when we're thinking about where the market is right now, how we should think about it compared to, I guess, that period of recovery from the financial crisis in 2007 and 8, where, as you alluded to, there was quite a lot of direct stimulus into the auto sector. And we've already had a couple of questions come through on the chat. So let's start. There's a couple which I guess you would expect on the auto side, and one which I think is a subject that always comes up, which is that of substitution. And we've got a question particularly about not just platinum palladium. I think that there's been a lot of discussion and one or two moves towards shifting the loadings back in favor of platinum over the last couple of years, but particularly about rhodium as well, which we haven't touched on so far in this webinar. Is there anything that the OEMs can do about relieving the pressure on rhodium in the short to medium term, or is this something that really they're going to have to live with, given, as you illustrated, that the emissions regulations themselves continue to focus on nitrous oxide?
Really sorry, so I'm not a technical expert here, so I cannot talk too much about the technical substitution opportunities that are here in the market. Sorry, I really no competence in that regard. I think in the end they will react to some extent on price signals, but to what extent that is technically feasible, probably no comment from my side. Before I say anything wrong, leave it with that. Yeah, sorry.
Indeed, but I think from what you illustrated in terms of automotive production rates, when you sort of line that up against certainly the palladium price chart, it kind of looks like the market and the automotive industry are kind of moving in sync. Prices has looked through the very short-term effects of the pandemic on consumer behavior. Your charts appears to illustrate that underlying production rates are picking back up again and have picked back up again. Is there a concern that this is sort of a temporary rebound and that you almost get a second wave in the economic effects as well as in the health effects, and that, you know, what we're seeing now in terms of pickup in manufacturing is simply a short-term bounce, and the real impact on consumer behavior is still to be felt? What's your sense of the level of uncertainty?
That's an interesting question, and here I'm feeling much more comfortable with your first question. Yeah, I mean, indeed, a lot of uncertainties here. I mean, you know, what's currently, let's say, is played on the financial markets is a kind of, let's say, robust and smooth recovery. And from the economic point of view, of course, we have a number of question marks still concerning the further development. I mean, what we have seen now is that compared to 2008 to 2009, particularly, governments and central banks have learned their lessons. Yeah? So they really flooded the markets with liquidity. They flooded the markets also with additional government debt and expenditure programs. Labor markets are to some extent shielded from the consequences of the pandemic so far. What you see here in Europe, for example, particularly the short-term labor schemes, really companies are bailed out currently and can keep their employees in their jobs without releasing them. And these negative labor market effects do not yet appear here. It's different in the United States, but even here we have strong subsidies to people, particularly in lower income brackets. So all of these impacts of the pandemic did not yet come through. And the question, of course, is how does that play out in the longer run? It really requires that to some extent, at least, we see an improvement also in this exogenous trigger, the pandemic, over the next year in order to basically have this underlying pressure on the economy going away and really have a recovery that is sustainable. Yeah? So it cannot, in the end, for a very long period of time, it will be difficult to sustain that in the current vein with really strongly subsidizing the economy and shielding sensitive sectors, sensitive industries, the labor markets, and so on from these repercussions. So I agree with you. There are a lot of question marks, a lot of potential risks, downside risks here. But on the other hand, I mean, what we have currently in the pipeline is a lot of vaccines, for example. I personally do not expect a really very fast, let's say, game-changing impact here, but also, I mean, given all the effort or the money that is put into these, we will see hopefully a positive development here in the course of next year. Yeah, so risks, yes, yeah, but also I would say some, let's say, confidence in positive future developments.
Yeah, thank you, Jim. You've got a very strong background in economics as well. Is that kind of tie in with your macro thinking for the next 12 months, given that we all accept there are even more large unknowns than usual, perhaps, but is that kind of how you view the world for the next 6 to 12 months?
Well, broadly speaking, yes. I mean, there's going to be a recovery, but much of this is financed on fiscal spending and monetary easing. We know pretty much, as far as we can, for these things that rates are going to be lower for longer. Every central bank has made indications on that level. But if you look at, I mean, one of the best ways to look at manufacturing, because outside of jewelry for platinum and the investment, of course, you know, you're really talking about autos and a lot of heavy industry, like petroleum and new high tech as well. And if you look at trade, trade is still weakening around the world, and that's very worrisome. So we really need to get, and we've seen that any increase in trade will stimulate industrial production, generally speaking. The demographic issues are still positive for auto demand in places like China, especially. There's still a very low auto ownership rate per 1,000, whereas certainly not the case in North America or Western Europe. So we do have a lot of hope from that instance, but we need to get personal income going again, and at least some level of price reaction. And right now, with there's a lot of hidden unemployment right now.
Yeah.
That is still restraining consumer demand. Frankly, I think PGM demand, given the level of economic activity, is actually quite good, and it shows the inelasticity of the demand. That's what's important about PGMs, is that you need a certain amount of it just to keep the world ticking over. Even if we were to go into a steep recession, you can't do without it. It's a strategic metal.
Yeah, and that's a good lead in, I think, to one of the questions, one of the other questions that's come through. And when I think about that lack of elasticity in PGMs, I think if we think of the three, platinum, palladium, rhodium as a whole, then there's clearly some degree of elasticity between them, but from the PGMs, they're clearly isn't on any kind of time frame that the markets consider. But coming back to the fundamentals which you touched on, and I think this is perhaps also partly answered by one of Peter's slides. There's a question about, given the whole move towards electrification of global vehicle fleets, do you not see in the kind of time frame that we can realistically forecast any meaningful demand pull on platinum with fuel cell growth, for example, or is that simply just too small a proportion of the vehicle fleet coming from too small a base to have a meaningful impact on your supply-demand balance?
Well, it would have to be certainly further out in the decade. That's for sure. Nothing immediate in the next few years. So, and we have to really wait for the technological developments. Fuel cells have been a bit like waiting for Godot, and they're coming and they're coming, and they may very well come. And there's a lot of work put into it. Certainly, there's been much more of a green push. And that's going to be very important, as well as for solar power for silver, for instance. I mean, and this is key, and it might take. We'll see what, but the leadership around the world certainly seems to be coming more to that conclusion, and it wouldn't surprise me if we saw some government intervention on the level to promote more research into that. But it's an interesting thing, Tom, because when I first, this shows you how old I am. When I first started looking at PGMs, and I first had the pleasure of your company, jewelry was by far and away the driver for platinum.
Yeah,
it wasn't autos at all, and the platinum market, as a consequence, was very volatile, very price volatile back in the 80s and before, and we only had a very modest auto demand for palladium.
Yep, and that's, when you look, one of the things that's quite interesting, and when you have a longish memory, when you look back at a very simplistic comparison of the platinum price and the kind of the pattern of platinum 2007, 2008, and then a recovery with the stimulus, you can sort of line that up with palladium today, 2019, 20, and see some similarities. And I guess one of the things that we ponder, but we don't have answers for, is whether the next 3 or 4 years is going to be similar. And this is the kind of...
the major buyer of the jewelry was Japan.
Indeed.
No one thought that China would be the world's largest platinum jewelry market back in the 80s, 90s, and well through the 90s.
Well, let's bring back the imponderables to Peter, because economists are always the people that we turn to for answers to the impossible. We don't have a lot of time left, Peter, but just wondered, given you work for a multinational, very large industrial entity, how does a group like BASF think now about CapEx, the cost of debt? It's really kind of, if you can take away the uncertainty about final demand, it's really a great time, isn't it? Your cost of debt servicing is in as low as it's ever been. CapEx is cheap. There's this stimulus washing around. Is that kind of a bit of a simplistic way of looking at things, or from the industrial side, is this a good time to be investing in your business if you can gain confidence in demand going forwards?
Yeah, I think the latter, what you said, is really the condition. Yeah, you really have to focus on the profitable and the growing markets. And I mean, cheap money is something that is not really new. Yeah, so interest rates were already quite low before the crisis. They now, of course, tend to be lower for long. Yeah, if you have a good rating in the longer run, many companies will be able to achieve or to get cheap finances. It really is depending on the selection of the investment opportunities, on the investment targets, what you do here basically, and that indeed, I mean, that needs really to be considered well here. I mean, in the end, we have the outlook on an economy that is slowly recovering with, as I already said, a number of risks here. We have to look, of course, at the very long time horizon here. That is very important. If you invest in a chemical plant, for example, you do not invest for the next 5 years or so, you invest for decades here. And of course, it's the question, what is driving these markets? And that is a very fundamental issue, as Jim already highlighted. I mean, population, for example, growth is a very important thing. We have the emerging world. We have a number of countries with quite significant population growth and also income growth in the future. These are also the growing chemical markets, and this is also where BASF is heading to. Let's say, advanced economies also have investment opportunities and pockets of growth in some, as you, for example, see currently in some segments like the care chemicals, which are doing much better than other segments due to the current economic and health environment. So chemicals in the end are used everywhere, and you have everywhere some growth opportunities, including the automotive market, with different drivetrains and different technologies that are in here. So yes, you need to invest always in order to, let's say, have a good fundament, a good basis for future growth. You have to select, obviously, the right countries and the right industries and places where you can do it. There's a quite general answer. Probably you have not expected much more, but I think there is still opportunity for growth in the chemical industry, and also need to invest. It's just a question of selection here. But indeed, you have to put your eggs into the right nest, only because money is cheap, you cannot do everything. That's of course also true. Your stakeholders, your investors would like to see a return.
For sure. I think we've just about run out of time there, chaps. So I'll just wrap it up there. Thank you so much for participating today, giving the participants who've dialed in some first-hand thoughts on where we are. I think it's very useful to be able to take a step back and look through the short-term volatility and the day-to-day headline noise that everybody is focused on, understandably from time to time, and consider, those slower moving fundamentals that play out over months and years. I know that there's an email on the screen if people didn't get a chance to put questions in through the chat and would like to email them through, and we'll certainly aim to respond to any of those that we can do over the coming days. But in the meantime, I think we've had something like 150 plus people dial in today, so that shows either the level of interest in the PGM market or the level of respect shown to Jim and Peter. Probably a combination of both, but thank you everybody for joining in. Thank you, Peter. Thank you, Jim, for taking time out to participate. And thanks to the LPPM and the LBMA for organizing this series of events.
Thanks, Tom, for having me.
Everybody.
Thank you. Bye-bye.
Taylor, I'll hand it back to you if you have any closing remarks.
Yeah, thank you all of you for joining us this week, our panelists and our attendees. We've been honoured to share this webinar with LPPM. Just a bit of housekeeping. We do have some upcoming webinars. So next week we have a webinar on US precious metals demand, and we'll welcome Albert Johnston III and John Reed that webinar. The following week, following our virtual AGM on the 29th of September, we will have an AGM recap, and then following that, on the 8th of October, we will have a webinar featuring digital gold. So just to reiterate what Tom said, we want to thank you for your time, and if you had any questions, please just email them through to us at ask@lbma.org.uk. So without further ado, thank you very much and enjoy your long weekend.